So welcome everyone to day 2 of Getting Youth Summit. Please welcome, use the chat section. Tell us where you're joining us from. My name is Chinwe Okoli and I'm the Executive Director of Grand Africa Initiative. We are really delighted to have you join us today, the second day of the Getting Youth Summit. We're excited to see you all joining us this morning or this afternoon, depending on where you're joining from. Please tell us in the chat section, where are you coming from, where are you joining from, use the chat section, okay? Now we go over to the next session directly. So the next session is investment readiness and financing option for startups and MSEs in Africa. So this session is just to build on the session that is just ending. Just as the name implies, it's about investment, fundraising, all around it. So whatever question you have while the session is going on, please engage in the comment section. Don't wait till the end of towards the end of the panel to start asking your questions. Start right now, whatever question you have about business financing and all of that. We have amazing panelists who are going to do justice to this. So we have for this panel, Mr. Modise Montlover, who is the Group CEO, Chaisis Capital Group from South Africa. We have Jordan Green, the founder and president, Melbourne Angels from Australia. We have Harry Tommy Davis, TD, the collaborator-in-chief, TVC Lab and president, African Business Angel Network. Mr. Oloremi Agbola, the head of SME assets at FCMB Nigeria. And to moderate this panel, we have Chukwemeka Fred Abata, the founder of CFA Media NG. CFA, Chukwemeka Fred Abata, is a co-founder of Godu Hub in Lagos, Nigeria, and founder Institute's Regional Director for Africa, supporting the launching of startups on the continent. He actively promotes African tech ecosystem through his weekly TV show called Tech Trends on Channel TV, as well as weekly column on Punch newspapers. He currently serves as the Director of Innovation Support Network Hubs, a network of 100+ hubs and co-working spaces in Nigeria. So he's also the Director of Nigeria Internet Registration Association, NIRA, managers of .ng domain. You're welcome, Mr. Chukwemeka Fred Abata. You have our attention, please.
Okay, thank you very much. Good afternoon, everyone, or morning, almost afternoon, everyone. It's a great pleasure to be here. Thank you to GAIN Africa for Youth Africa for this invitation. And I listened through the first panel. I think that great value, amazing value came out of that. All right, so for this second session. I have a very interesting lineup, like you've mentioned, and I'll just go ahead to give a brief info of each of them. So I'll start with Modise Motloba, who's the founder and group CEO of Chaisis Capital Group South Africa. It's a niche Pan-African financial services and investment group specializing in fund management, lending, advisory, and consulting, as well as wealth and principal investment. Modise has extensive global experience and track record spanning more than 27 years in major sectors such as an area such as banking, SME development, fund management, insurance, etc. Modise holds a bachelor's degree with majors, bachelor's of science degree with majors in applied mathematics and computer science. Join me and welcome Modise to this panel session. Next is Harry Tommy Davis, TD. That's the guy that we respect a lot in the ecosystem, who set out as a system analyst, turned tech strategy advisor, public speaker, and today what we know him the most for is angel investing. So TD is an angel investor, and also the collaborator-in-chief of Technovision, co-founder of Lagos Angel Network, and president of the Africa Business Angel Network, IBAN. TD can be reached at tommydavis.com and on LinkedIn, Facebook, Instagram, and Twitter at Tommy D. Welcome, Tommy Davis, TD. Welcome, sir.
Thank you.
We also have Jordan Green, who's passionate about the contribution of angel investors, and he's the founder and president of Melbourne Angels, one of the top angel groups in Australia, where he initiated the national angel community. Jordan is an advisor to governments, communities, investors, developing angel networks. Join me and welcome Jordan Green.
Thank you.
Finally, is Oluremi Agboala, a certified SME specialist with over 19 years experience, spanning banking operations, internal control, inspection, loan monitoring, portfolio management, and product development. He's currently head of SME assets at FCMB and responsible for SME risk asset portfolio, including ideation, business development, product management, data analytics, and credit creation. Join me and welcome Oluremi Agboala, head of SME assets at FCMB. Welcome, Oluremi.
Thank you for having me.
All right, with that said, just to give a bit of background to this topic, right? So it gives me great pleasure, and I'm proud to be part of this. What we're discussing is something that is at the heart of, economic development for Africa. I know how, investment or funding remains a challenge for a lot of startups and in other cases, MSMEs. But it's something that we must tackle because we require the young people who are creating ideas and solutions require this funding to sort of bring some of the ideas to reality, and the funding can come in any front. So it's a very interesting topic, investment readiness and financing options for startups. But I think that even before you talk about financing options, it's also talk about investment readiness, right? So the fact that you have an idea, doesn't mean that you're investment ready, right? So we need to discuss what are the ways to become investment ready so that when you present yourself before angel investors or before a banker, you have the right product or solution that you want to sell to them. All right, so what I would do is, to allow each member of the panel session for the next 5 minutes. I'll start with Modise, then I'll move to TD, Jordan, and then Oluremi. To just share your perspective on investment readiness and financing options for startups and MSMEs in Africa. So for the first 5 minutes, you could talk about the subject and then we'll come back to the actual Q&A. Thank you very much, everyone.
Thank you very much and good morning. It's afternoon here in South Africa. Program Director, thanks very much for the opportunity. Talk about investment readiness. Really, it straddles from a young person who's really starting his business from scratch. And I think from that point of view, the real issue is really an idea. I always say that I love people and I follow people who, when I look in their eyes about having to start a business, I can see all of it. So I can literally see a business plan in his eyes in the way he articulates it. And for me, when it comes to startups and early stage kind of investment, I as an entrepreneur, as a founder, I look at that and once I start believing in the concept and the idea that that person has, actually move forward in terms of being able to support them. And that's really where you have angel funding kind of spaces that comes in, and including the crowdfunding, more particularly from a community and from a family point of view. So that's for me is the first stage. Now, if you then start looking at a micro-entrepreneur kind of a thing, the investment readiness for them, for me, it's all about just having a business concept. I mean, I always say that don't give me a business plan if you're really a true entrepreneur. Tell me the concept, write it down, give me the basic how you're gonna do that, because business is about making money. And if it's really about that, all right. So for me, when you are a micro-entrepreneur, all that I really want, and you're being ready is really be able to have a plan, a written down plan of what you need to do. I'm not talking about a business plan that's got all these other things, but if you can tell me what are you selling or what would you like to sell and where is your market and how you're going to make money. So for me, that would be the second stage of a micro-entrepreneur. Now, when it comes to a small enterprise, that's really where one gets into a business strategy to say, do you really have it written down? Have you even started this business? Because my view around business is also that you must start it. If you find that that small entrepreneur has really started a business, they've got a business strategy, and I call it strategy again, written down, and they've tested the market, and they actually can come out with some results that say, it's actually working, but I need more capacity to be able to build my business going forward. And I would then say, this is an ideal person. Yes, one has to go through some due diligence from a funding point of view, but I tick that off when I see somebody has started a business, somebody has run, somebody's got a documented plan, and somebody knows exactly what they're doing. And when it comes to medium-sized businesses, and some of them maybe higher and small to medium-sized, that's really when one expects a lot more in terms of a business plan, in terms of a record of the business itself, whether it be management accounts, whether it be state financial statements, and whether it be just the record of the progress and the capacity and the resources that that entrepreneur would actually have in this regard. And so it gets a lot more extensive. Now, when it comes to then financial products, which we can talk about it later, then the products then will have to follow through just the stage of entrepreneurship, particularly from a youth point of view, that one is looking for. I can stop there and allow my fellow panelists to also just talk about from their perspective. But for me, that's what I call investment readiness. Thanks.
Okay, so Tilly, please, next to you, Tilly, kindly give us your topic, and then after you do Jordan and then Oluremi. If Tilly is not, hello, Tilly.
Yeah.
Okay, please. Yes. So each speaker should take the next 5 minutes to speak to the topic, and then we'll jump into the Q&A.
Well, I have a slight challenge with the topic because to me, startups and MSMEs are in two different worlds. They are fundamentally different organizations. A startup is an institution that is using innovation to solve a problem in extreme uncertainties. They are doing things that have not been done before by anybody else. And the expectation is that they will therefore grow very fast. That is the first differentiation. As a startup owner, you are managing rapid growth. A typical startup, if it's really a startup, will see anywhere from 20 to 100% month-on-month growth, both in top-line revenue, in the number of people they have to employ, and the kind of customers they are taking on. That is the first significant differentiator between a startup and an MSME. The second is funding, which is what we're talking about now. Angel investors and venture capital typically invest in startups, not in micro, small, and medium enterprise. The third and final is the fact that startups right from the beginning have to think about exits. So when an angel is putting in money or a VC is putting in money, they're putting in money with a very specific time horizon expectation of the returns. And those three things therefore make a startup different. And therefore the funding approach, investment readiness, and all the topics different from a micro, small, and medium enterprise. A micro, small, medium enterprise typically will have a formula that they are following, whether it is a restaurant or a hotel, whether it is, logistics. It's something somebody has done before, therefore it's a template. And the bet in terms of investment readiness is on execution. So when you're looking at an MSI, I can't pronounce it, micro, small, and medium enterprise, the bet is this individual or is this team capable of executing? So it's a single complexity assessment, so to speak. You're only looking at, can they actually build a better mousetrap, for the want of a better explanation. Startups, on the other hand, are dealing with extreme uncertainty with an untested and untried product. So it's a fundamentally different game in terms of looking for this, in terms of investment readiness. And that is why angel investors exist to start with, is the fact that banks at that time are not prepared to bet on startups. Excuse me. It is the angels and the VCs who take the high risk approach. And to do that, for example, if you look at how we look at it, the first thing is we test the vision. So we look at the background of the individual to try and understand exactly where this individual is coming from with respect to the problem they are solving. Then we look at the problem, then we look at the solution that they're professing to it. If these three click, it's then you start to understand how ready are they for investment. And investment in startups, which is what I'm speaking specifically about, occurs in multiple stages. There is what we call the ideation stage, where it's just an idea in the head of the individual. And the measures there, you're actually betting, just like in the micro instance, you're betting on the individual's ability to bring their vision to life. The next stage is when they've got what we call a minimum viable product. That is, they have something and a number of customers. In that case, your assessment is around the product viability and its value to the customers and the potential for growth. Once they have an MVP and they are getting increased customers, you're then starting to look for what we call product market fit, which is the sustainability of their revenue. And at that stage, what you are trying to look at is that revenue trend, as I talked about earlier, month-on-month growth. So there are different assessments in terms of investment readiness when it comes to a startup's growth. Because the readiness required for an angel, well, actually starts with what we call founder, family, and friends. Some add the fourth F, which is fools. Some would say fans, but by and large, what you're looking at there in terms of investment readiness is totally different. Because at the stage when your dad is putting in money or your best friend is putting in money, they trust you, okay? But you're still getting money and you are ready for investment at that time because you've got the idea and you think of how you bring it to life. By the time you're getting to an angel who's your first external investor, the requirements are different. The documentation is different because that typically is the first agreement you enter into. Now, investment readiness for venture capital is totally different yet again, because at that time we're looking for standardized processes, okay, that are repeatable and independent of individuals. We are looking for an ability to grow the customer base. We're looking for revenues. So there are fundamental different stages of investment readiness when it comes to a startup. I trust that helps. Thank you.
Thank you, TD. Jordan, please.
Thank you for. Hello, CFA. Can I go on?
Yeah, please go ahead.
I'll come from a different perspective to what my co-panelists have discussed. Basically on the same line, but to a financial institution like a bank, what a startup means to us is that you are starting your business newly. And we know that on the continuum of business categorization, you start with an idea, then you move to elite entrepreneur, then you go to startup. Then from startup, you can now say, okay, medium enterprise, and start going to medium corporate and large corporates. So that is how a bank actually categorizes businesses. And as my colleague has said, Mr. TD said just now, the most difficult era in a business setup is the startup stage, because you are doing something you've not done before. You don't have experience, and for you now to present yourself to a financial institution to come in and say, okay, I want to support you, it's a lot of work you need to put into it. And I will start from there. What will make your business bankable? What will make a financial institution want to lend to your business at your stage where you are, at the stage where you are? And we have learned that, okay, the first is an ideal stage, then you move to early entrepreneur, there where you have started something, then you now move to early startup. You move to a startup business that you are now seeking for finances, whether from the angel investor or equity participation from outsiders, people that want to invest in your business. How do you get to that stage? Because in Africa, from my own experience as a financial institution and my own experience as a product manager for some years, I find out that most businesses are not bankable and can be as a result of different things. When you need to identify what are the things that will make me to be able to go to a bank and say, okay, I want the credit, you need to first of all separate your business from yourself. That is, you have to make your business registered. You have to separate the ownership of your business from what you do. And you have a separate entity, legal entity for your business by registration. Because financial institutions are run by credit policies, they have study standards of people they can deal with at each stage. Then I will take it from the scratch. You can go in there and say, okay, I want to open an account. I start with a business name. I start with my name as an individual consumer. Because you are just starting out as a youth, as a young person, you don't have anything yet, like a business idea you really want to, so you are just at that idea stage. Then while you keep on, start getting yourself documentations in terms of how do you keep records of what you do in terms of bookkeeping in your small business and your idea. Are you putting it down? Are you writing things on it? That one will lead you to make sure that by the time you are asking for financial help, you are already having documents to present that, look, I've done this. These are my historical thing. Then you have to take the informal nature out of your business. You have to let it be consistent and be sure that your business is more structured and more legal. And you have to give it a legal structure by getting registered with relevant government authorities, because that is, government can only deal with, in SMEs, bank can only deal with businesses that are registered for SME loans. If you want individual consumer loans, they can give you loan to buy television, buy small things on your individual capacity. But when you want to grow your business, it's on stages. When you start from the consumer side, you move it to a little bit of personal business, then you now move it to a registered business. Then from that, you need to start moving up from that and getting yourself the bankability ability, the bankability documentation that you will need to present to an organization. So in terms of that, you need to check yourself, what does the bank need to assess credit? We all know, as financial students, of all the 5 and 6 of credits, you need to make sure that, number one, your character is impeccable, and you have to be able to have documentation to show in terms of your credit history, how you borrow money, now you pay back. That, okay, even if you borrow money from friends and family, do you have a culture of paying back? All those things, you have to be able to get a credit rating that will tell you that, look, you can lend to your business. And another thing is that, okay, some people have perceptions that, okay, on this business, I just have the ability. Idea is, in Africa, we have a lot of ideas, but how do we practicalize it? How have we been able to successfully translate our ideas into concrete things? Those are the things that a bank will look at. Do you have the ability to move it? Okay, what are your business acumen? What are your experiences? What are your previous business fits that a bank can support? What is your work skill that the workforce that you are working with has been able to adapt and bring out value for people to buy? Then another thing is that when you want to get a business, you need to know, is my business profitable? Does it need a bank loan? Does it need a just equity contribution without me paying a loan, not a debt? You need to understand all those things that, okay, do I need a first debt finance at this time, or do I just go for equity participation and open up my business to partnership and get money that I don't have to be paying interest upon? And another thing is that when you want to get your business ready, what is the purpose of the funds I need in my business? What exactly do I want to use this money for? And how much do I need? And that one will lead us to, how much do you have to pay from your profitability? Can your business support the interest you are going to be paying? But as a financial institution now, for them to even consider all these things, what are your second options? If you fail from your business, what are the options that for them to get their money back? Those are the things that the financial institutions will look at in your getting ready for business and getting ready for finances. You need to position yourself by getting adequate documentation ready and make sure that you have a transparent financial department that you can show to people, and you make your character must be impeccable in the sense that you must be able to show credit worthiness, a credit rating that you don't have negative credit scores. So all those things are what the bank look at then you must be able to provide a little bit of security to back up your facility. So from the banker's perspective, that's what I would say. You need to get your financial ready. But there are a lot of other options that might not need collateral, because those are the conceptions that people, you can't go to bank because they will ask you to go and bring a land and something. There are other ways of funding. We have discussed here, the previous panelists have talked about guarantees, about even lending based on even clean lending. Banks in Nigeria are doing clean lending now for SMEs, and all those things are available, that we just do a cash flow lending for you based on the cash that you have. They give you options. So those are the options that are available. And when we talk about costs, there are a lot of intervention funds out there that have brought down the cost of lending. The government has provided some cheaper funds. International DFI is to bring some other funds that are below market rates, that are accessible for SMEs, even for startups, as we speak as of today. So don't, just for the sake of introduction, let me just stop here as we continue.
Thank you very much. Thank you very much, Oluremi. Jordan, please, over to you.
Thank you very much. It's a pleasure to be with you all today. So I broadly agree with everything that my colleagues on the panel have said. We are talking about two different groups of businesses: startups that are trying to do something quite radical, and the micro and small, medium enterprises. Even if they're brand new businesses, they're not aiming for the same sort of growth. So I think those are both important. And the gentleman who just spoke told you a lot about the bank side of things, so I will leave you with that. Because a startup, one of the things that's different about a startup or about an angel investor is that we're looking to take the risk, and we're investing our money. And it's important to remember that an angel investor, we invest our own money, all right? The bank is managing somebody else's money. A fund manager is managing somebody else's money. An angel investor, we're investing our own money out of our own pocket. We're investing to own a part of your company. We're not lending you the money. We're buying shares in your company. With a view to one day being able to sell the whole company, or perhaps just our shares, but normally the whole company, to somebody else. So the journey that we're going on is about coming alongside you as the founder, believing in you, and taking the risk alongside you. So one of the things you have to do if you want to be ready for investment from an angel investor is you have to really know who you are, what you intend to do, and why you're going to succeed. Because a big part of what the angel investors do is ask those questions. Not always directly, but those are the answers that we're looking for. We want you to tell us how you're going to change the world, even if it's just in a little way, but that's what does the big radical innovation type activity that a startup is characterized by. It might be just a better way of buying a house. It might be a better way of making an appointment with a doctor. It might be a better way to order a coffee. It doesn't have to be something that's going to save millions of people, although that's also a wonderful thing to try and do, of course. But telling us how you're going to change the world, and in terms of what you're going to sell as a product or a service, telling us why people will buy that, showing that you actually know your customer, you understand your market. What we don't want to see is that you've just had an idea that's good for you, and so you assume everybody else wants it. You have to go out and speak to your prospective customers, speak to your prospective distribution channel, speak to your competitors, and you will always have competitors. So finding out how the world really works and then showing us that you know what's going on and why your opportunity is going to be appreciated, why people will spend their money to buy whatever it is you're selling, that is really, really important. We know it's going to be a big risk. We're prepared for that. we're coming into your company and we know we're probably going to be with you on this journey for 5 years, for 10 years. It's not going to happen overnight. But the change that you're trying to build is the underlying strength of your business. And so showing that you understand the change, you understand why people will want to make that change and why people will pay for that. All of those things are really, really important. And then as the other panelists said, you have to have your financial plan, how the business is going to work, the business model, or as the previous panel mentioned, the business model canvas. All those things are tools and they're all important. But those are also the mechanical pieces that we can help you with if the big part of it is already there. If we really believe you've found a great opportunity and you understand how to go and get it. So I might leave it at that as an introduction.
Okay, so I saw TD smiling while you were speaking. You're probably speaking his language, and so he was all smiles. TD, so let me just jump to you to the next question. So talking about investment readiness for startups, what are some of the things that you look out for as an angel?
Well, over the years, we've sort of honed down to what is called the POEM framework. So like I explained earlier, the first thing is this a large problem, that is going to sustain a business is the first thing, we're trying to understand, which is what Jordan was talking about there. And does the founder really understand the market they're about to go into? But once that's been sort of accepted as a given, we then sort of do what we call a drill down. And in drilling down, we're trying to understand, first of all, the strength of the founder. Are they driven as an individual? Are they passionate about this mission? Is this a difficult problem to solve? And really, like I said earlier, does it have a significant impact? And what's the competitive environment out there like? Are the solutions out there addressing this problem really inadequate? So like you talked about making a better coffee, people didn't think about that, but look at Starbucks. So how innovative is that solution? What's the unique selling proposition, to borrow from something somebody said earlier? And probably most importantly, is the business model sustainable? And to determine that, you're looking at positive market growth. You want to see a strong product or service line, including their product development capabilities. You want to understand what that unique competitive advantage is. The ability to execute by the team that has been assembled is critical. And what access do they have to resources? Then, once you've got all of that in place, it's about looking at the revenue potential, or revenue, if it's already a revenue base, what kind of profitability they can get to, and really how much money are they going to need to get to full flight? Because yes, I talked about family and friends being first round of funding, angels being the next round of funding. Typically a startup will get multiple rounds of funding before we get to what we call full flight. That is, they've scaled and they're employing people and they're returning money on the investment. So there's a lot of criteria, and I really don't want to bore people with all the details we're told we actually look about, but that at a high level is what we tend to look at, because just to layer onto Jordan, angels also hunt in packs. So you will find typically that it's not an individual angel only. When I'm excited about something, my syndicate gets a call to say, hey guys, you really, really need to see this. And by and large, what you're therefore getting, or what you're bringing to the table, is not just one investor or one bank or one individual. You're talking of multiple people who can not only bring cash, but more importantly, the connections into the different aspects of business society, and probably the most expensive part, which is what's costing me a lot nowadays, is time. So providing guidance, providing advisory, either as a mentor, as an advisor, these are all the components at the behest of angel investors. I trust that helps.
All right, thanks, Teddy. I'll jump to Modise, basically to hear your perspective. I mean, Teddy and Jordan are obviously on the startup side, obviously, right? Modise, you kind of also look like you're on the startup side, but let me just try and believe that you are both ways. Is there a way you think that the regular financial institutions can sort of provide financing options that can, because they fund more SMEs, they can also fund the startups? Is that ever possible in your thoughts?
Well, I mean, it's possible, but maybe to answer that, let me just give you the perspective of the business or the funding products that I deal with from my business point of view, just taking angel investment out. I'm in a space of what we call enterprise and supply development in South Africa. And basically, it's an initiative that tries to bring in the corporates, the big corporates, and basically encourage them. And here in South Africa, we use legislation to basically encourage them to provide a few things for entrepreneurs. And most of them will be the small to medium-sized entrepreneurs. And this is really where we become practitioners to make sure that happens. So the mechanism runs like this. We know that there are banks and there are angel investors, but corporates also have a role to play in doing three things. One, in providing access to funding, which we actually manage ourselves as my company, in also providing access to markets, which is also part of the de-risking in terms of the access to finance mechanism that we put in place, and also providing capacity and skills. So I run a company that is a practitioner in that space where we approach enterprise companies and we bring in, so it's a matchmaking kind of an SMEs in that space to really access those opportunities that the corporates actually provides. Now, when that happens, it's actually a much more easy aspect for us to manage. So we then come with expertise where, number one, we'll then screen. So if there's an agreement, I'll give you an example, from a source of funding, the corporates will allocate 3% net profit after tax, enterprise and supply development. And we will then access that money to do three things, like I said. We will then identify the SMEs within the supply chain and outside the supply chain of those enterprises, of those corporates. And we'll then really take them through the drill. So who are you? What do you do? What's your business like? What kind of scaling opportunities are you looking at? What's your capacity? Are you compliant in terms of legislation? And once we've done the initial screening and we're happy with that, we'll then take them through what we call then the due diligence around how fundable are they in that space. A lot of our instruments is really loans and actually grants. But then we will then take them through the drill and the due diligence process of really honing into the business and really ascertaining ourselves whether this entity can be funded or not. So once we get that process, and it's really a typical due diligence, what angel investors and everyone will do, but once we understand and we're happy with that, then we're able then to go through our own credit process and provide funding to that entity on the back of the supply, the contract that they would have received from these corporates. And then the rest is easy for us. Then we would monitor the loan that we would have provided, make sure that we get our money back. We will also look at the sustainability, make sure that they're profitable, they're sustainable, and really have a monitoring and evaluation tools that we use to ensure that they're actually successful in this regard. And so that's a space that I occupy. And it's somewhere in the middle between what banks would do and maybe on the other side of angel investors. So it's really the core of that target that we're doing, working with, will be a small to medium-sized enterprises. I think the startups will have their own. We have our own in-house venture capital business, which really looks into startups in this regard. But I think this is a great product and a great solution that we've innovated around it in South Africa. Can look at. Because I think in the past, you will have big corporates really not really creating an ecosystem of support to the SMEs in this regard. And in South Africa, we're working on that. And we already have some legislation that talks about that. And that seems to be then providing this huge pool of access to funding that the SMMEs actually are looking for in South Africa? Thanks.
All right, thank you very much. Interesting model, I must say. I mean, it's pretty interesting model. I mean, it's something that, you know, more African countries should look at and how to support the small business sector. But let me ask you this question. Time is being fast being spent. The level of risk that banks are willing to take around, you know, SMEs or startups. Although a lot of startups will hear you when you said that startups are anybody that's just starting. You know, startups will not agree with that definition. But you said from a bank's perspective. So, but do you think that, you know, or what is the maximum level of risk that you think that a bank would want to take for a good idea, you know, that is viable?
Okay. Bank is a financial intermediary. They provide funds from people that have surplus to people that need the funds. And those people are expecting returns on their funds. So be that as it may, the banks have a criteria to select those people they can give funds to. And they are a little bit in the credit policy of the bank. But for startups, as you have said, the risk at which a bank can take on a startup varies. And it depends on the stage where that startup is. For example, in our own bank, FCMB, we have different products that address different stages of startup and SMEs, even the micro businesses. You see, we have developed some product that can attend to people at the lower rank of businesses. When you are in your idea conceptualization, you can start by having a PBA account, that you have a personal business account. That one you can run it on your name, on your business name. You can move on from there and have a business corporate account. And in all those places, at each stage, we provide what we call SME advisories. You see, the advisory people will sit with you. They will grant you in the act of what you are doing. They get to know, and at this stage, they give you business advices that will take you to the next level. Like, okay, you are a personal person now, you've been running your business in your personal capacity, you need to register a business. They get you corporate affairs people that can help you register that business. You need financial literacy in the terms of how do I prepare my financials to be bankable? They refer you to organizations that can help you do all such things with minimum finances and help you to be able to be presentable to the bank for a bank loan. And those are the things that the bank is ready to take risk. And I've said it that in all this spectrum of products, there are different combinations of collaterals. There are some that are actually clean lending based on cash flow lending when you are just starting out. For example, we have a business loan we call quick loan. That one is for an apprentice. If you just finish, in Nigeria, we have people that go to a trader to learn businesses. And when you learn and you finish your apprenticeship, you need to start up. We know you don't have money to take off from the grant maybe your boss has given you to take off. So we give you a particular loan based on the percentage of your turnover, cash flow lending on what you bring into your account, and we give you a percentage on it. You go and do it a short-term lending, then you can be able to grow your to about 10 million naira on that line. And we have people that have grown from such to medium corporate and large corporates in our network. So it depends on where you are, and all the risk that the bank is ready to take are calculated to make sure that the shareholders' funds is maintained and the value is gotten for the investment they have in the bank.
Sorry, I'm sorry, CFA. To do this, Remy, only because the founders of the bank and a lot of the senior management of the bank are friends of mine. I think everybody here should also be aware that FCMB has Hub 1, which actually supports and funds startups the same way they have Workspace for startups, address agri-tech and other allied areas, and they assess them for investment readiness and actually fund them independent of the current commercial trends that you have spoken to. I have actually put a link for those interested into the group chat My apologies, CFA, you may continue.
All right, sir. Okay, apart from Hub 1, we have SME clinics that we run for. Virtual SME clinic, we even have it.
Sorry, Oluremi.
Just a minute. Let me meet. Just a minute.
We have less
Okay.
than 10 minutes to go.
All right.
I mean, there's no other marketing you want than the one he just did for you. I think Chinwe should send you guys a check so that you can send an invoice so that you can send a check. But anyways, Jordan, let me come to you quickly. For you, what are some of the other options that you think is available to small businesses or startups, whatever way you want to look at it, that they can take advantage of beyond the early money that angels like you put in?
Well, I think part of the answer is that you don't have to look at it as just one or the other. So if you really want to get some bank finance for inventory, the bank will be much more willing to lend if you've already got an investor who's backing the risk that you want to take in growing your business. And investors don't particularly like backing things like inventory. So one of the things to understand is when you're building a business, there are different sources of money and you probably want to use several of them. And they reinforce each other. So if you have an investor, a bank is far more likely to want to look at you for bank style finance. And if you can get bank style finance, an investor is much happier about the prospect of the business being successful and growing. And I'd just like to deviate a little bit from the question to make another point, which TD in particular touched on but didn't follow through. When we think about a business growing and the other end of the business, the sale of the business, crystallizing the capital value that's in the business, it's important to understand that there are different types of value that someone will buy. It's not always just about revenue and profit. In fact, the biggest returns are not about the dollars, because unless you happen to be a very, very big company already in terms of revenue and profit, if a big company wants to buy you, your revenue and profit probably don't make that much difference to their bottom line. So big companies that want to buy a small company that's growing, they're usually buying it for what we call strategic reasons. Now that could be your market spread. It could be that you're a South African company who's spread all the way through sub-Saharan Africa, or it could be that you're a Nigerian company who's tapping into the rapidly emerging middle class, and the people who buy you want to get more of those people into their customer base. It could be that you've actually got some technology that it would take a while for you to actually really fully exploit, but somebody else, if they can bring that into their own business with more market power, with more distribution, with more marketing, with other products and services, that they can actually extract the value from that very quickly. And the reason I mention all of that in answer to this question is that you do have to probably, if you're going to be a growth company, you will probably need several rounds of financing, whether that's investment or it's debt, but you will need multiple rounds from different sources. And you have to be able to think about how each of those affects your business in terms of its appeal to somebody who might want to buy your business. And this is perhaps going back to the beginning, that one of the differences between an SMME and a startup is that a small business, an enterprise business, is not necessarily building itself to be sold. It could be building itself to have a good, sustainable revenue and profit. Running a good business for 20 years will give the owners a wonderful life, and it employs people and it provides valuable services. But an investor is looking for a capital return, and that means building a business that's going to scale in value as quickly as it can. And so the value driver is an important thing to think about. And a company that, for instance, has a lot of debt on its balance sheet may not be suitable for an acquisition, but it could be a long-term operation. Now, you've also got grants. I've noticed in the chat, lots of people have referred to various grants in various countries. and then some of them through the development bank may be available across the whole continent. So grants are good because they don't dilute your ownership. They're usually, if they're an actual grant, they're not repayable. So grants are very, very good, but of course they're very competitive. And again, your best chance of getting a grant may be if you already have one of those other forms of funding locked in as well. If a bank is willing to give you some of the money, that may make you more appealing to a grant body, and vice versa. If you're able to win a grant, that gives you a certain degree of confidence in the operation of your business because you've got that funding, and that may make you more appealing to an investor or a finance provider. So the message I guess I'm giving in answer to your question is that whether it's investment, debt provided by a finance provider like a bank, or a grant, you shouldn't necessarily think, if you're going to be an entrepreneur, you don't think about just one of those, you think about all of them and how you can build that mix and use one to get the other. Not one to pay off the other, that's not the way to play the game, one to get the other. So I think there are many forms, and then there are, of course, cross-border and offshore funding of those types, but they're a lot harder to get. They're very competitive because the whole world is looking for them. So I would recommend that for the most of it, you stick within your own community and look for the funding there, because to the message of this summit, Africa is emerging in a strong way, and there are a lot of people who are right there with you, the other gentlemen on this panel, who are trying to help, who are trying to make a big difference. And I really think that that's the place that you should go.
Thank you, Jordan. Interesting. You and TD, I think you guys should get on the call after this meeting, because there's a lot you guys have in common already. Okay, so we are almost out of time. I've got some questions here. One of the questions that I have here, I wanted to ask TD because it was directed at him. TD, the question says that Africa, from your definition, it doesn't seem that Africa has enough startups. Is it a funding or innovation problem? If you can take that in 1 minute, I would appreciate it. TD?
My answer is Stripe just got acquired for $200 million. Stripe was started in 2015. It innovated the back-end payment systems. So that's my answer.
Okay, but you mean Paystack, right?
Paystack was yes, I call it Stripe for Africa, because that's what they call, that's what Shola, no, seriously, when I first met Shola and Ezra, that's what they told us they were building, was Stripe for Africa. And that was in 2015. Less than a month ago, they got acquired for $200 million by Stripe, and they have become the Stripe for Africa. And True. There's Paga, okay, there's Flutterwave, there's Andela, the list goes on. Okay, these are all companies that have raised in excess of $10 million. So therefore, I submit that startups do exist, they're alive and well, and they're thriving. Go to tommydavis.com, take a look at my portfolio, you'll find some of them there. Thank you.
Okay, so we've run out of time, but I just want to take each speaker to sort of give a final comment. Say final comment and what your thoughts are about the platform provided by Gain Africa for youth empowerment. So Melissa, we'll start with you, and then we'll go to Oluremi, Jordan, and TZ rounds it off. Thank you.
Thanks. And let me thank Gain for the opportunity. I think this target market called youth is quite critical for the future of our continent. We've seen some specific targets, for instance, in terms of participation in the economic space for the youth itself. And I must say that from where I'm looking at the targets and the space that has been created for youth, it's quite minimal. Nothing has really happened. So just from an opportunity point of view, I think there's a lot more space for youth. And I think if we as a continent become deliberate around creating and fostering youth entrepreneurs, I think will actually create a much more better legacy for our continent and so forth. So I would want to say that and encourage GAIN to do that. From a funding point of view, I want to say that I really look more on the soft side from a funding point of view. I think for me, our view should be, yes, you have all these requirements that you want from startups, from SMEs, but I think the first thing is actually you must have to look at them first and really just measure if they ideally are fundable, but more importantly, what kind of support they actually want to leave. I always look at an SME and a startup to say that if I really believe, I think money should be the last thing from a funding point of view they should worry about. Why don't we help them get to that point where they need to? But I think it's all about the business model that they have. And I think there's a lot of innovation in the continent. And I wish the youth of the continent all the best, particularly those that are having startups or SMEs. Thanks.
Okay, thank you. In my own closing remarks, I would just want the youth to know the opportunity provided by the platform of GAIN is very critical at this time when, especially in Nigeria, for Nigerian youths. This is an avenue for us to grow and for knowledge-based growth for the youths in this nation. And if all of us can sit down and learn and get one or two information from this platform, and they wish they can do more by doing classroom training and lectures for youths to make sure that all their ideas, they can put it into something that is bankable and can get funders to invest into them. We have great youths in Nigeria, and I know this platform is going to be very good for them to latch on to go to greater heights. In my closing remarks, I would just say, well, in terms of FCMB, we have various options for them to go to. If they go to fcmb.com, that is our website. They will find out from FCMB Hub 1 to SME, to SME Zone and to SME She Ventures. We have a lot of innovative things that the people can learn, trade. They have trainings on it that they can learn from it. They can handle them to do a lot of things, and we do a lot of webinars and seminars, virtual and in-house, that we can invite them for. They can just go there. There's a lot of opportunity there also for them to tap into. So I thank the platform provider for this opportunity. Thank you.
Thank you. Jordan, please, your final thoughts and what you think about the platform.
Thank you. Well, I think it's wonderful what you're doing. I'd like to just include in my final remarks a quick response to this issue about innovation or funding, because I think what you all need to understand, and here I'm speaking to the whole of the audience, is that that's a question everywhere. That's not a question that only you face. Innovation leads, and that's what TD was saying. Innovation leads. So you have to be doing something different, and if you're doing something different, if you're doing something inspiring, if you're doing something that really gets people excited, then the funding will come. And to the rest of the people who might be listening, who might have some money themselves or might know people, you don't have to be super rich to be an angel investor. You should get together collectively in what we call angel groups, or what TD called syndicates. Because if we work together, we make better investments, we help more people, we create more jobs, and we create a better future for our communities. And I think that's what GAIN is doing. I think GAIN is creating a community that will allow young people to realize that the future is theirs to make as they wish. You don't have to worry about government regulation. You don't have to worry about all of the other things that might look like they're difficult. You have to imagine the future that you want. And then Mrs. Okoli and the GAIN community will provide you with the tools, with the opportunity of how to learn, where to learn, and who to talk to. And then you just have to do it. And the fact that your countries, for the most part, have very young populations gives you a huge advantage over the rest of the world. So I would say the platform is great. It's been a wonderful privilege to be here today. And I hope that all of you will grab the opportunity and surge forward with whatever your idea is. You have to try it. If you don't try it, nothing will happen.
So TD, I mean, you and Jordan, I can imagine what announcement I'll see next between ABAN and Melbourne Angel, but yeah, TD, over to you.
For actually, you know, together. We are all on the same journey of building a prosperous continent that's characterized by sustainable development. Okay, one that is driven by committed, capable, entrepreneurial, and innovative young men and women. Okay, so what I want to leave you with is really the values that gain. This is not about diffuse thinking. We have to have integrity. You heard all the speakers. The first thing everybody is looking, say what you're going to do what you said you're going to do. Be true to everybody. Results are important. We strive for excellence. And most importantly, okay, I think the South Africans call it Ubuntu, synergy. Okay, because of you, I am. And there is more in us than there is in I. I hope that makes sense to you all. Thank you for listening.
All right, on that note, I'd like to say thank you very much to every member of the panel. Thank you for your time, for your knowledge, for your experience, and to our audience, thank you for listening to us. We appreciate you. Don't stop building, don't stop creating solutions, don't stop solving problems. You know, that's the only way to get our continent forward and move things ahead. Gain Africa, thank you so much for this opportunity. Chinwe, it's over to you. Thank you, everyone.
Thank you very much, CFA and the excellent panelists. This you can all agree with me that this session was rich, was deeply insightful. A lot to gain from it. You know, we are all about gaining. We're all about giving value, and we're happy that you've all gained from this. So many of you are sending me messages. You actually want the session to continue, but we have to move on to the next one. So thank you so much, Mr. CFA, for moderating that session. Thank you, Mr. Oloremi Abola from FCMB. Mr. Harry Tommy Davis, TD, thank you so much. Mr. Jordan Green, I really appreciate you for joining us all the way from Australia. I know it should be about night right now, but you joined us, thank you. And Mr. Modise Motloba from South Africa, thank you so much for your support, sir.
Our programs seek to achieve sustainable development by igniting the positive energy of the greater segment of Africa's population, the young men and women. Grand Africa Initiative, GAIN, promoting youth empowerment for development. Join us for a greater impact together.